Hello everyone, I'm Stephen Fox. Welcome to my channel. We've been hearing for months how resilient this economy is. Are you feeling like this economy is resilient? Or are you feeling angry every time you go to the grocery store and everything it costs twice as much and you get half as much for paying twice as much than you used to? I think that picture of the economy is beginning to fade very quickly. And I think the way it shows up in the economy most evidently right now is with fast food. People are going to fast food less and paying less when they do go there. McDonald's and other big brands are warning that the low-income customer is starting to crack because they are feeling the pinch of inflation as their money has to go to other necessities. This effect was especially noticeable for Starbucks, who indicated that for the first time in 3 years, their same-store sales dropped for the first time in 3 years. People are coming in less often, and when they do come in, their tickets aren't including as many items as they used to. So it's really a bad sign when you can't get your caffeine-addicted customers to keep coming on in. This trend was solidified in my mind by the report from Yum brand, symbol YUM, which owns Kentucky Fried Chicken and Pizza Hut. They also indicated that same-store sales have fallen. So we have these major fast food outlets, which I think are a true indicator of how the low-income customer is doing, and they are hurting. And what has happened? Artificial intelligence has crashed, and I had my stop losses in place, and they again saved me from disaster. I think in my mind, and it's probably because I traded it a lot, Super Microcomputer, SMCI, really took a beating. Super Microcomputer reported good earnings, and they had a good forecast, and their revenue was good, but it was not as high as analysts predicted. And they're not allowed to be less than perfect when they have grown in price as much as they have. So they had a B plus report, let's say, and analysts were expecting an A plus report, and they penalized it heavily. After hearing SMCI's earnings, the bears attacked in force and overwhelmed the stock. It was flying near the 900s, and it went down to about 737. Of course, Super Microcomputer's earnings affected NVIDIA, and this whole market has been leaning on NVIDIA and relying on artificial intelligence to keep things up. But of course, NVIDIA was affected. Looking at the chart, they went from hanging around the $890 to coming down to their 50-day moving average of about $830. They don't report earnings till May 22nd, and they could still pull a rabbit out of the hat. It's looking a little bit grim. And I don't think it's so much the artificial intelligence companies. I think part of it is how much valuations have increased, so how much expectations have increased. And I really think the general economy and how that's weighing on the consumer is starting to affect the outlook. And I think that's probably illustrated pretty well with Amazon. Amazon had wonderful earnings, A+ earnings, okay? This stock should have shot up 10%. But it did not. And that's what really alarms me when you have a stock that should be taking off and going to the sky, and it does not. And it just kind of holds still. It went up a little bit, but not nearly enough for how good their earnings report was. And I just take that as such a bad sign for the general market and for the Magnificent Seven especially. Amazon is probably the best reading of how the general consumer is doing. And after they reported earnings, this would be like if you had a rocket you were launching and it didn't explode. It just didn't take off. It just sat there on the launch pad because it's virtually unchanged. In fact, it might be down like 1% or something since it's reported earnings. So it's just a big disappointment. And I don't think it's Amazon's fault. I think it's the consumer, and I think it's this general economy. There are Amazon Web Services, which does the majority of their income now, actually did very well. So it should have taken off like a rocket, and it just kind of sputtered on the launch pad. And looking at the 1 week chart, the 5-day chart on Amazon, you can see it just kind of sat there. It tried to take off a little bit initially, but it just sputtered out. And so this is such a bad sign when a good stock, when an A-plus stock does not take off. And to me, that says there's something wrong in the general economy, especially with a consumer-oriented stock like Amazon. Well, at least we can say for Amazon is that they kind of stayed the same after earnings. What's more outrageous is that the largest stock in the stock market, the $3 trillion Microsoft, has gone down from $424 to about $394. And this is after an A-plus report. It did wonderful. This is a wonderful stock that owns 49% of OpenAI. They're going to be big in artificial intelligence, if not the leader. So when you're getting bad results on great stocks, it tells you you're in a bad situation in the market. And finally, a comment on the ridiculous BS session we just had with Jerome Powell, head of the Federal Reserve. He is terrified that we're going to go into a recession, I think. The main questions I would like to ask him is, what do you think would happen if you raised rates 1/4 point? Because I think I know the answer in the back of his mind. And it would be that the economy and the stock market would crash with a thunderous roar like you've never heard before in your life. I think it was like fantasy. And some of the commentators says, oh yeah, man, we're headed into a soft landing. Does this look like a soft landing to you when the greatest companies can't do anything, when the consumer is getting pinched? When you have great stocks that go nowhere and even go down, this is not a formula for success. But the analysts prior to the interview, before Jerome Powell did his interview, which is kind of the main thing because they try to determine where he's going or where his head is at. And they concluded right off the bat that, man, it's dovish and, oh, this is great. And the market shot up. And I watched it with disbelief because I said, this is fantasy. And I think the bears decided, yeah, we're going to put an end to this fantasy. After it went up a couple 100 points, it started to go down. I went into my triple leveraged inverse fund, SQQQ, which is my favorite just because it contains the Magnificent Seven and the 100 largest companies on the NASDAQ. And if the big technology goes down, SQQQ is going to go down. And I'm so familiar with it. They tell me statistically I should be doing SORTY, SRTY, which is a triple leveraged inverse fund on the Russell 2000, which are smaller companies and which are more affected by interest rates. But I have the familiarity with SQQQ, and I benefit from the headlines because the media follows these major companies very closely and you find out like that what's happening either plus or minus with the Magnificent Seven, which is what really drives the direction of the SQQQ. I don't think I want to do this too much for right now. It was above 15, the VIX. The VIX was above 15, which just barely met my criteria. But after hearing Powell talk and seeing how this just went vertical after he talked, went vertically up, I decided, yeah, I'm going to jump on SQQQ and reap some benefits. And that's exactly what happened. And I think I'm going to play with it for now. I would prefer that the VIX hits 20 before I really start going in depth on it, really start shorting a lot. But the SQQQ is cheap. Right now it's $12, so I can do a lot of shares. And typically I do about 10,000 shares at a time. So this is my game. This is the way I roll. Good luck to you all. I think we're all going to need it. I think we're on the edge of having a recession. I think Jerome Powell is terrified of a recession. There is no risk of him raising rates. He knows we would crash immediately. There's hints that we're going down from the job market. The job openings have lessened, and I think we're going to get future job reports where the job market is getting somewhat more difficult. There's signs that manufacturing is having trouble. So we're right on the edge, and he did not want to push us over the edge of the cliff. And so he was trying to be relatively reassuring to try to keep the market up, because the risk really right now is not inflation. It's going into a recession or even a depression. Thanks a lot.